Hey guys, welcome back. In today's video, we are talking about the 5 billion plus swaps, how shorts are at risk, why apes will win, and many more in this video. First, we're taking a look at this. So yesterday, we've talked about the whole situation with how many shares of AMC there are out there that's unsettled. And now this is what they do, and TRS hedging explains. So this is total return swaps. So to understand this, essentially is short position, the market maker sells short 10,000 shares of a company's stock. The hedger they enter into a TRS to receive the total return on 10,000 share of the same stock. So this strategy helps offset the risk of the position. Now, the understanding of this whole approach is the fact that it allows the market maker to maintain their market making function while managing their risk. The TRS provides synthetic long exposure, balancing the short position without requiring the market maker to borrow or purchase actual shares. So that's the reason for obviously why they do this. And like we said, it came to a shocking number where we are seeing 555 million AMC TRS and again 282, and it's just understanding truly how many shares of AMC exist out there and why it's obviously a whole bigger situation than we thought in the first place. We've always had data and we've always understood what is happening, but as we go into more digging and deep diving into what's happening, you're seeing this whole thing of being uncovered, and this is what we are looking at. And this goes back, and this is something that we've talked about in the past before, actually last year, but I thought of bringing this back again, and I think that is very important where we're looking at the credit swaps. So this is the total return swaps, this is the credit swaps, but it's understanding that we had the first leg of 5 billion plus expiring on April 22nd, 2026. So we're obviously still very, very far away from the expiration date of these swaps, but it's just seeing and understanding just what is out there for AMC. And like we said, is why we always need the due diligence, why it's obviously important, but it's always how we knew that there's corruption and manipulation that's happening in this. And again, you can obviously go and take a look at this for yourself, but it's to see right now that for the total return swaps, for everything included, this is the very minimum in which we are looking at. Obviously it can be a whole lot more than this, but the very fact we already have this many that are existent, you can understand why AMC's price is always being suppressed. And if you take a look at this, we recently talked about how there was 0 shares available to borrow, but then magically it went from 0 to 3.7 million shares available. So we went from 3.2 to 0 and then suddenly 3.7. Now, this is something that we have obviously seen in the past where magically shares have just kind of appeared out of nowhere. And we know the reason for this. And when you take into consideration everything that we've talked about on this channel, we've just talked about the TRS, we've talked about in the past with the tokens as well. There's obviously plenty of ways for the shorts, for these brokers, for these institutions to obviously locate and kind of make shares of AMC. Remember, it comes to a point where they don't need any actual backing, even if they have a token, even if they have the swap, even if they don't have a physical copy, they can just make a share out of nowhere. And so the fact we're seeing 3.7 obviously shows that it's very likely they're back to their usual tactics. But this is another thing to understand, is that the very fact they're doing this, they're obviously creating synthetic shares. And when they are creating synthetic shares, you have to understand is that holding AMC at 350 is not going to make individual investors leave. It's just going to help all of us load the boat with more synthetic shares that you'll be forced to buy back at a much higher price. Investors will win and you will lose. So this is obviously talking about kind of the mindset of the whole apes in terms of what they do, what they react when they see the price going down. And it's like we talked about. Yes, you can obviously use all of these synthetics to suppress and manipulate the price of AMC. You can keep it down, you can try and make it continuously go down. But what they're actually doing is that they're creating an incentive for the apes to buy as opposed to sell, because everyone understands the situation that we are in. They realize that when the price is going down, it isn't because people are losing faith in AMC and selling their shares, but rather it's because of the fact that shorts are worried more and more, therefore they need to push the price down more and more. And so they're creating more synthetics that's obviously bought up by the apes, and these will be forced at one point to obviously be bought back at a higher price, and is why, of course, apes will win and that the institutions will lose. Because when you take a look at this, your shares of AMC and GME have infinite time limit. Market makers derivatives don't. They have expiration dates and cost a F ton of money to put on and hedge with. This type of business model is not profitable for market makers, and they know that. And so this is what we have to realize, is the fact, and I've said this multiple times before, as always, none of this is financial advice, so do take out a grain of salt, make sure you do your own due diligence and research. But like we talked about, it costs us nothing to hold on to the AMC and GME shares, but it costs the shorts everything to hold on to their short position. We talked about they have to spend more money to create new synthetics, they have to spend money to finance their existing positions, and they have to put up more collaterals, which traps them in other positions as well. And one thing is as well is obviously when it comes to that possibility of dividends, not only would it not cost us anything, but it will actually give us money for holding on to AMC and GME shares. And it's like we said, is why we always understood the assignment from the start, that we will be the short sellers because we have infinite time, but the short sellers don't. And when you take a look at, in kind of further, what we're seeing is this, which is the Robinhood initial margin calculation, January 28th, 2021. Now you can see here is that they had a massive margin risk because of AMC and of course GameStop. Now in this case, the AMC value at risk was obviously higher than the GameStop. And what we're seeing right now is obviously understanding that, of course, AMC along with GameStop poses a risk. And something that we've been seeing recently, at least that I've been seeing, is a lot of people are arguing between AMC and GME. And like we've talked about, these are mutual short sellers. We're seeing things happening for GME, and then people are saying that only GME will squeeze and not AMC. But you have to understand is that both are in the same situation, but both have put different risk towards the short sellers. We're seeing here AMC had a massive margin requirement, and that's to Robinhood, and it's obviously one of the biggest reasons for why they pulled the buy button. But it's also understanding here in terms of how many total return swap shares there are for AMC. And so like we talked about, it isn't just going to be GME that squeezes, it will be both AMC and GME. And it won't be a matter of which is better, etc., etc. Again, there is obviously reasons to support why potentially AMC will run up higher, and there's always reasons to support why GME will run up higher. But at the end of the day, we don't truly know what will happen. It's obviously with the data and what we can derive. And the most important thing that I want to talk about is that it shouldn't be a thing where it divides us together. It should always be the thing that retail against hedge funds. It's not AMC against GameStop, but rather it's retail against hedge funds. And so that's all I'm going to say. Like I said, I don't think one stock is better than the other. I've talked about their business structures and why I said AMC has good things and why GME has good things. And so it's just to understand that both short sides will, of course, take a hit regardless of which one goes up first. And then you can also see here, and this is what some other people think. I think GME is what's going to open the gate to the MOAS, with it being in a better fundamental position to squeeze short sellers. And AMC is what's going to be the nail in the coffin for short sellers. Short sellers are going to bet heavily against the company in depth, and when it doesn't work, all that effort gets reversed. So in terms of what I think he's saying here is that, again, he's obviously agreeing with both GME and AMC are in the same positions, but they just have different pros and cons. When you take a look at GME, we talked about, whilst they don't still have a actual business structure yet, they have billions of dollars that's able to generate millions of interest that's actually put them into a profitable state. Whereas, of course, AMC, they don't have billions of dollars, but what they do have is a working business structure that's obviously scaling. And like we said, if it's for the fact that it comes down to the one with better fundamentals in terms of on the balance sheet, and that's what's going to cause the MOAS, then of course GME will be that. But like we've said in the past, like we've seen in the past, the fact that AMC post such a big risk here, like you can see 75% of Robinhood's margin, 555 million FTDs that are out there, and that's the very minimum, then you can understand why AMC will be the nail in the coffin for the short sellers, and is why both are very and equally important as each other. And guys, thanks for watching. I'll catch you guys next time.